Liquidity isn't hard, it's misunderstood, and it's the most important thing in all of trading. And without liquidity, you cannot be a consistently profitable trader. So in this video, I'm going to teach you what liquidity is and how we can use liquidity sweeps to get into the best trades possible. Okay, so what is liquidity actually, right? We hear about this all the time, liquidity. What actually is it? It's simply highs and lows, right? Highs and lows. Most importantly, on the higher time frames, so the daily and the 4-hour, key highs and key lows will have lots of orders there. Now, what do we mean by orders? We mean stop loss orders. Now, why is that important? Stop loss orders will have billions of dollars, right? Remember, on the daily chart for gold, there will be billions of dollars at this low and this high, right? People shorting will have their stop losses here, and people going long will have their stop losses here. And by people, I'm talking about smart money. Now, smart money are large banks, large institutions, hedge funds, all that sort of stuff, who have billions of dollars, and they move the market. We don't move the market. Day traders don't move the market. Scalpers don't. It's them with billions of dollars. They move the market. And in order for them to actually get their orders filled, and what that means is for them to actually get into a trade, is they have to do business at key highs or key lows, right? That's it. That's what liquidity really is. So these markets will only move for higher time frame liquidity. And this is so important because so many people understand, key highs and key lows, but then they look at, the 1-hour key high and they think that's the most important thing, when they don't realize there's a key low on the daily chart that price is going for. And right, so we're on gold, we're on the daily chart, and we're going to look for the most obvious high or low that price is going to go for. I hope it's pretty clear. Maybe it's a bit bigger. We're going to go for this low here. Now, why are we going to go for this low? Let's mark it out. There's lots of liquidity at this low. We know it's a key low. We know that gold's been in the bull market, right? So people have trailed up their stop losses here, here, and here, right? Some people might have had it here. But here, there's so much liquidity. There's so many orders here for smart money to target. And another thing you can do whenever you're unsure whether price is going to go for this low is just look at the order block, right? So we're going to look at this order block here. So I'm going to mark out the order block, which is just the last down close candle before the up move, like that, right? You see how price aggressively comes into it and wicks deep within it? That right there isn't really respect of an order block, right? Because what you would expect if it was a valid order block and we were still bullish, you'd expect price just to tap it with a wick and then quickly move off. Right, but we don't have that. We have a massive, aggressive down close candle. And when you see candles like this, and you see the candle closing into the order block and wicking deeply, that shows you there's complete disrespect of the order block. Right, we're not bullish in any way, sense, or form. Right, complete disrespect of this order block, and we've got key liquidity here. And you might hear this being called a liquidity pool, right, or whatever. The terminology is not important. But what we know is that for gold, currently, we're going to go for this key low. This key low, there's been no respect to the order block, and we've got this obvious key low. Now, what does this mean? Because so many people get this wrong. This right here is your daily bias, right? So we've already figured out daily bias just by using liquidity. Right? We've used liquidity, and we know our daily bias. Now, that means when we get on the lower time frames, we're only going to look for shorts on gold. We're only going to look for shorts, right? So many people, they do this, and then they start looking for longs on the lower time frames because it looks bullish. You don't do that. You only look for shorts. But, and this is so important, when we get in the lower time frames, we're going to look for liquidity sweeps. Right, we're going to look for liquidity sweeps. Now I'm going to explain more about that when we get onto the lower time frame.
Okay, so liquidity is simply stop loss orders, and you'll find liquidity at major highs and major lows on any time frame that you trade. But the higher the time frame, the more important the liquidity is. Now, this is what's super important about liquidity. Liquidity is only there to give you the direction of the market. That's the only reason we care about liquidity. It's not an entry pattern. It's not a technique. It's just a tool, right? A concept to help you predict where price is going to go. Because let me tell you this, after 5 years of trading, once you got the direction right, you are 90% of the way there. All you need is a simple entry pattern. So liquidity gives you the direction of the market. Once you got the liquidity right, you will know 9 times out of 10 where price wants to go. So you will find liquidity at major highs and major lows. And what happens with liquidity, especially on the higher time frames, either the 4-hour, daily, or weekly chart, is this will act as like a magnet for price action, literally pulling price towards it. So what that looks like is this will literally magnetize price towards it, right? On the lower time frames, just pulling price towards it. And there are so many entries that you can get, right? There's so many easy entries that you can get on the 5-minute, 1-minute, 15-minute, even the 1-hour chart, riding price up to key liquidity pools, right? And if you're ever unsure about what liquidity, price wants to go for on the overall time frame, this is the technique, this is the tool, so make sure you pay close attention to this. You get onto the 4-hour chart, like you are now, and let's just imagine you get on the chart and this is what you see, right? This is live trading right here for you. You've got to just ask yourself, which high or low are we likely to go for, right? And it's pretty obvious in this case, but it's not always going to be obvious. to you, right? So make sure you do pay attention here, right? You're going to come on the charts and you're like, are we more likely to go for this low all the way down here, this major low here with stop loss orders, or are we more likely to do this? Are we more likely to come up and take out this high here, right? Hopefully, pretty obvious, at least in this case, that we're likely to take out this high, right? But that is your technique for finding the liquidity, finding the daily buyers. It's to just get on the 4-hour chart and ask yourself, which major high or low is price likely to go for? And that right there will give you daily bias, weekly expansion, weekly bias, whatever you want to call it. That is how you determine daily bias. You don't need to mess around with multiple time frames, the monthly chart. Just get on the 4-hour chart and ask yourself which high or low is price likely to go for. But now that we've got our liquidity, we know that this is our target, right? So when we get onto the lower time frames, we are only going to trade in this direction. We are only going to look for longs to ride price up to this target here, because that is the highest probability entry.
Now, for those who struggle, there are multiple different terminologies, for saying liquidity. So liquidity, the exact same thing that liquidity is stop loss orders, right? That is all that liquidity is. It's just resting stop loss orders. And, the way that we know that stop loss orders are going to be there is because there are traders who still trade support and resistance, right? There are still traders who trade support and resistance. Now, at this level here, and we're on gold, we're on a daily chart, right? At this level here, this key daily high, and in fact, this is all-time highs. Lots of people are shorting gold, right? They think this is an all-time high. They're going to put their stop loss orders here, and they think that when the price comes all the way up, it's going to bounce off this level and continue down, right? That's what support and resistance traders think, right? Now, if you've been trading for any length of time, you know that's a complete load of BS. It does not work. It does not work. And, I spent years trying to trade that way. It does not work at all. Now, what we do know, though, is there's going to be lots of liquidity, right? Lots of stop loss orders at these key highs and key lows. And now what we want to do as a liquidity trader is we just want to target that, right? We just want to target stop loss orders, or we just want to target liquidity, right? It's that simple. That's all we need to do. So all we need, right, in terms of liquidity, is we just need to see on a higher time frame. So in this case, the daily chart, where price actually wants to go. Now, this is something you'll note. Price will move for where the money is, right? They'll move for where the money is. Now, the money is essentially where people's stop loss orders are, because smart money who move the markets, who have billions of dollars, they can't just trade on the 5-minute chart or the 1-minute chart. They can only get in and out of their positions at key highs like here and key lows like here, right? Where there's going to be lots of stop loss orders. That's the only way smart money, so like Goldman Sachs, JP Morgan, and hedge funds, pension funds, the only way they can get in and out of market is at key highs and key lows where there's lots of liquidity, right? Lots of stop loss orders. So price will move to these highs and to these lows. Now, why does that matter for us as traders, right? The only reason it matters is it gives us the direction of the market. Right? It's so important. The only reason we look at liquidity on the higher time frames is it gives us the direction of the market. That's all we need, is a direction. If we've got a direction, you're 90% of the way there. Right? That's only so long. And most of your time in trading shouldn't be spent on finessing some sort of entry. It should be spent on getting the direction right. Because if you can get the direction right, you're literally 90% of the way there. All you need is a simple entry model. Because look at this, right? Look at this. All you needed was a few good longs here, right? Getting, let's say, a free risk to reward ratio. You would have made a lot of money. A lot of money. This is the overall direction of the market. Can you imagine you trying to short in this, right? Imagine shorting it against all these up-close daily candles, right? Low probability, but trading with the trend, trading where price wants to go to liquidity is the highest probability in all trading. So right now, we know that price is bullish. We know that price wants to move for stop loss orders on the higher time frame, because that's the only way that smart money can get in, right? That is why, price isn't bullish because, let me show you, it's not bullish because there's been some sort of market structure shift, right? Because the body here has closed above this high. That is not the reason why the market is bullish, right? You got to think, is Goldman Sachs really, right? Or, is any big bank, big investment bank, are they really going to buy and sell based on a market structure shift? Oh, we've had a market structure shift on the 4-hour chart. We've got to sell now. No, that's not what it is. It's all for liquidity, right? It's all for liquidity. So here we are on the daily chart. We know there's lots of stop loss orders here, and price is going to move for those stop loss orders. So all we need now is to go on the 5-minute chart or any lower time frame and just trade in that direction.
You're going to use the 15-minute chart, right? And you're going to zoom out and you're going to look for the most obvious highs or lows. Now, I hope it's pretty obvious, and I've marked it out for you. I hope it's pretty obvious. We've got liquidity here, here, here. We've got almost triple highs on gold, right? There's lots of liquidity. There's lots of stop loss orders at this high here, right? So we just mark this out. Lots of liquidity, which is just another way of saying stop loss orders. So don't get confused. by the terminology, right? That's all liquidity is. It's just stop loss orders, right? Right here, there's so many people shorting gold, hoping, this is all-time highs, right? And they're trying to ride gold down, and they see a bit of bearish movement here, so they're even more confident. As price comes up, more and more people are shorting, hoping, right? They're hoping that price is going to come all the way up and bounce back down. Now, if you've been trading for any length of time, you'll know you'll know that price does not bounce at random support and resistance levels. What will happen is, if we are bearish, price will come up, it will take out these stop loss orders here, and then it will start to reverse. Or what could happen is, if we're bullish, right, if we are bullish, price will just smash right through these levels, right? If you notice, in both scenarios, both bullish and bearish scenarios, price is going to move up towards this key high, right? Now, what we do at that level, whether we reverse or continue, doesn't matter. All we need to know is that price is going to move towards this key level here, right? Because there's lots of stop loss orders. That's all we need to know. Now, you might be asking, why do we need to know that? Because that gives us the overall direction of the market, right? That's the only reason we use liquidity. Very, very important you understand that. We don't use liquidity for anything else apart from giving us the direction of the market, right? Liquidity is not for your entries. Liquidity sweeps, which we'll talk about later on, that is what you use for your entries. So right here is our liquidity. That tells us that we're bullish and that we're going to take out these highs, or at least we're going to trade in that direction. So what that means is, when we get on the 1 minute or 5 minutes to look for our entries, we're only going to look for longs, right? Very, very important that you understand that. Lots of people, they don't understand why we actually use or care about liquidity. The reason we care about liquidity is because it gives us the direction of the market. That's it. That's the only thing we care about, is a direction. Because if you don't have a direction when you're trading, you're gambling. You need to have a direction. You need to have at least, some logic or confidence of why price is going to go in that direction. So we know lots of stop loss orders here, lots of liquidity, very, very likely that we're going to trade in that direction.
Okay, so what is liquidity? We hear all this talk about liquidity. What actually is it? It's simply, where are the stop loss orders, right? That is it. That's all liquidity is. You've got to ask yourself, where are the stop loss orders? Because these markets will only move for where the money is, right? Very, very important. Make sure you write it down, that these markets will only move for where the money is on the higher time frames, because these markets, I'm sure everyone knows, are moved by big banks, big insurance companies, hedge funds. They're the ones who move markets, right? If you want to move euro dollar, the S&P, any major market, even crypto, you need billions and billions of dollars. And the only way these institutions with billions of dollars can get in and out of their positions are at key highs and key lows on the higher time frame. That's where all the money's going to be. That's where all the stop loss orders are going to be. And the reason there are stop loss orders, and we all know this, is because of support and resistance, right? We all heard, that price at this level here is key resistance, because we've got a high here and high here, high here, high here. So what they think, or what traders think, that price is going to come up like it's done here, and it's going to bounce off, right? It's going to bounce off this level and go down. Now, if you've been trading for more than 3 months, that's a complete load of BS. It does not happen. What actually happens is that price smashes through these levels, right? The only reason we have equal highs here is just to generate liquidity, right? Just to get people start shorting the euro dollar so we can smash right through it. That's the only reason these highs are impact, right? So that is what liquidity is. That is literally all liquidity is. And the only reason these markets are going to move are for these higher time frame stop loss orders, right? Because there are hedge funds that have their stop loss orders here, right? And you might not believe it. You might think, oh, doesn't everyone know about liquidity? Trust me, there are so many hedge funds. There's essentially two ways of looking at it. First, there are hedge funds that have literally a 10% win rate or below, and then they aim for massive trends. They're going to hold for years, as day traders or swing traders. We don't want to hold for years. But they're looking to capture, massive trends over years, and they're happy to get, lose 9 times out of 10, and in the one trade that they do win, they hold on for years, and they make like a 20 risk to reward ratio. That's one type of hedge funds. The other type of hedge funds, and you've probably heard this stat where it's like 90% of hedge funds underperform the S&P 500, and they make the majority of their money from churning. Now, what that means is the hedge fund makes their money from getting in and out of positions, right? They make all their money from a commission, not from actually making a return for the investor. Now, I'm not going to talk too much about that, but trust me, I worked at a big bank, and these big banks will literally rob investors of their money. They make all their money from commissions. They don't care whether their investors lose or win. They don't give a shit. They make all their money from. But anyway, all you need to know for trading is that at these highs here, there is so much liquidity, there's so much stop loss orders, and that the market is going to move for this, right? That's all we need for liquidity, right? All liquidity does is it gives us the direction of the market. So hopefully, clearly, we're bullish and we're looking to target these highs. So we're going to look for longs on euro dollar until we take out this high, right? And then we'll see what price does, right? If price just smashes right through, then okay, we'll look for the next liquidity over here. But if we get some consolidation like this, we'll just wait a few days and then see what price it does. Because they want to go up, or is it going to start reverse, right? That is all we need for liquidity. Liquidity gives us our direction. Now, most people, maybe if you look at liquidity, you might understand that. You probably understand that. Now, hopefully that makes sense, right? Markets will only move for higher time frame stop loss orders. It's the only way big banks and big, insurance companies, hedge funds can get in and out of their position. What liquidity does is it gives you the direction of the market. We know the direction, we know we're bullish, but that alone is not enough to make money, because for years I could get the direction right, but I couldn't make money. And the reason why is because I didn't wait for a liquidity sweep. So I'm going to get a lower time frames. I'm going to show you what a liquidity sweep is and how you can enter on the highest probability trades possible. Okay, so the first thing you need for liquidity is you need to use a higher time frame, right? So you've got to use either the 4-hour or the daily chart, because this gives us the direction of the market, right? The first thing we need to do before you get onto the charts, or as soon as you get on the charts, is you need to have a direction. You need to figure out where is price most likely to go. Is it likely to be bullish, right? Is it likely to do something like this, enter on a retracement and take out some sort of high? Or is it likely to do this, right? Is it likely to be bearish like this? Or third of all, which not many people talk about, is it likely to just consolidate? Because if it's likely to consolidate, don't trade, right? That takes some discipline not to trade. But for the direction of the market, the only thing you need to use is liquidity, right? You don't need to use breaker blocks, order blocks, fair value gaps. You don't need any of that. You don't need volume profile. You just need good old liquidity. Now, liquidity, for those who don't know, it's essentially where would people put their stop loss orders, right? We're on the higher time frame, we're on gold, and this is a major market. It's probably one of the biggest markets in the world, right? Apart from like the S&P 500 and euro dollar, gold is probably one of the biggest markets in the world, right? There are billions and billions of dollars. There's huge institutions all looking at the 4-hour chart and the daily chart, and at this key high here, right? There are people shorting gold because they think it's at, at all-time highs, and then there are people who want to buy gold. Now, for those who are going to ask me, and I personally think we're going to hit 3,000 on gold. That's just what I think. But nevertheless, what we need to use for the buyers or for the direction of the market is we just need to look for where is the most obvious stop loss orders, right? Now, I hope it's pretty clear, right? It's pretty clear. We're in a bull market. Let me just zoom all the way out, actually. We're in a bull market on gold, right? You never ever short these things. It's pretty obvious that price wants to go to this high here, right? It wants to go to this high here because there's lots of people shorting. There's lots of people who use support and resistance, right? Who think that price is going to come up to this level and then bounce off like that, right? Now, if you've been trading for any amount of time, probably about more than 3 months, you'll know that is a complete load of BS, right? If price was to reverse, what it would actually do is it would do that, right? It would go up slightly. It would take out anyone who had their stop loss orders here, which is the liquidity sweep, and then it would reverse, right? And you probably had this all the time when, let's say, you're using support and resistance and you thought price was going to go down. It does, but it takes out your stop loss and then goes, right? Because these markets only move for stop loss orders, and they're highly, highly manipulated. And me and you, as retail traders, we're not supposed to be profitable. This is not for us. This is for the big boys. So these markets are highly, highly manipulated, and they run purely based on liquidity. But we've got the direction of the market, right? We know where the higher time frame liquidity is. We know where the where the market actually wants to go. We're going to expect price to move up like that, and then we want to enter any sort of retracement on the lower time frames, right? We expect price to come up and then break through this level. So now that we've got the direction of the market, right, all we're going to do is we're going to get in the lower time frames and we're going to look for our entries. That right there is so important. I'm not on the 5-minute chart trying to predict where price is going to go. I'm on the 4-hour chart and daily chart looking for the higher time frame liquidity, the bigger picture. I've got my direction now, so I don't care what the 5-minute or 1-minute chart's doing. I'm only going to look for long. So very, very important that. Very, very important. You don't need to use lower time frames for your bias. Use the higher time frames for your direction, and then use the lower time frames for your entries. Now, where there's lots of money, that's what we call liquidity, right? Liquidity means how easy it is to get in and out of a position, right? And it's easy to get in and out of a position because there's lots of stop loss orders. There's lots of money there. So right here, we've got triple highs of gold. We've got one high here, and we've got a third high here, right? Lots of people are going to think, right, like price did here. They're going to think, right, that price, because price came down, and when it comes up again, it's going to come down. They think this is really good resistance, right? They think this is really good resistance, support and resistance. We all try this as beginner traders, and we weren't profitable with it because it does not work, right? It does not work. That's not why the markets move. The markets only move for liquidity. And if you'll notice, you might be saying, oh, well, it worked here, right? It worked here. Price came up and it bounced off and went down. The only reason price did that was to get more and more people shorting gold, right? If you just zoom out on the daily chart, we're a massive bull market in gold, right? So the only reason price did that was to get lots of people to stop shorting gold, right? So we know at these levels here, there is so much liquidity. Let's just move this down. There is so much liquidity, right? There's so many stop loss orders. There's so much money, right? There's billions and billions and billions of dollars worth of stop loss orders, all at these highs here. So what smart money are going to do? Smart money, this entity that actually moves price, what they're going to do is they're going to force price up to these highs. And then once prices are in these highs, they can start buying and selling. Whatever they want to do, they can get into that position because there's billions of dollars there. They cannot get on the 1 minute chart and just press, buy and sell like we do, right? They don't have the luxury of doing that. They can't just buy randomly. They can only buy at certain areas because they've got so much money to move into the market. So the only thing we use for liquidity, right? This is all we need to do for liquidity is we just need to target it, right? We get on the higher time frame, we find the obvious, like the next obvious liquidity pool, and we just target it. We use it to give us our direction for the market. That's it. It's that simple. We don't need to do anything crazy about liquidity. So right here, we know, right? We know that price is going to come up and it's going to come and take out these highs here, right? Price is going to come all the way up, like it's on here, all the way up, take out all these stop loss orders, and then we don't know what price will do next. It could continue up like this, right? Continue up and then go to all-time highs, or what it could do, right? What it could do is price could come up, take out these highs here. Smart money can get into their position, and then it could consolidate. It could reverse a bit and go down. Like who knows what can happen? But what we do know is that at key highs and key lows, smart money will move price there so they can get into their position, right? That's what we know, right? So that's the only reason why these markets move. So we've done our liquidity analysis on the daily chart. We know that price is bullish. We know that price is going to come all the way up and to take out these highs. All we need to do now is get on the lower time frames and look for a simple entry pattern, right? And then we combine the entry pattern with a liquidity sweep to give us the highest probability trade possible. Okay, so what is a liquidity sweep? A liquidity sweep in its most basic form, it's a fake move, right? It's a stop run in the opposite direction of the higher time frame, right? So let me say that again. A liquidity sweep is a fake move and it's in the opposite direction of the higher time frame, right? The move is designed only to take out stop loss orders. So what that means is when you're in a bullish market like we are for gold, and this works on all markets by the way, but for gold we're bullish, and to determine if we're bullish or not, you need to use liquidity on the higher time frame. Now in this video, I'm not going to discuss that because I have so many videos on the channel discussing that, so make sure you check them out. But assuming you're bullish and you've got the higher time frame direction, the higher time frame bias, whatever you want to call it, what we want to look for is suppose price comes up, price moves down, retraces down. Lots of people are going to put their stop loss orders here, thinking it's safe, and then they're going to buy any sort of dip. Right, price comes down, it just takes out their stop loss orders here, and it quickly moves off like that, right, in the opposite direction, and then it retraces, allowing smart money traders, those in the know, start entering around here, right, at a fair value gap, order block, and optimal trade entry. Anywhere around here is where all those traders in the know who are waiting for this liquidity sweep, for this fake stop run, they're all entering around here. They're buying, and then price massively moves off. Great to take profit, right? That is what a liquidity sweep is when you're bullish, right? And this must have happened to you so many times. It happened to me all the time. I forget the direction of the market, right? But I just couldn't make money. And I couldn't make money because I'd have my stop loss here, price would come down, it would take out my stop loss and then quickly go to my fake profit. And if you've been trading for a while, that must have happened to you so many times. And it's the most frustrating and annoyingest thing in trading. And the reason it is because you haven't waited for a liquidity sweep, right? So we have to wait for a liquidity sweep. And if we don't wait for a liquidity sweep, you're going to be the one getting swept, because that's what a sweep of liquidity really is, right? Stop loss orders here got swept and then price quickly moved off. Now on gold, run the 1 minute chart, and let me just say this because I have to say this every video because people keep asking me this. First of all, it works on every single market, so gold, forex, indices, futures, crypto, stocks, penny stocks, any financial market that has candlesticks. This liquidity and liquidity sweep will work, right? It's rooted on deep logic and that actually moves the market. And second of all, it works on all time frames. But what I will say, and this is so important, the lower the time frame, the more significant, or at least the more often you'll get liquidity sweep. So the more entries you'll get, right? That's what I'm really saying. So run the 1 minute chart for gold, and what we're gonna do, I'm gonna make this a bit more bigger. You see this move here, right? You see, right, we're bullish on gold. You see this move here. Let me make this so clear. You see this fake move here, price quickly moves down just to take out these stop loss orders here, right? Anyone who trailed up their stop loss from here to here, any stop loss orders that were here got taken, right? Price just came down, it quickly, aggressively moves off in the opposite direction. That right there is our liquidity sweep. And then any retracement after the liquidity sweep is high probability. And then we just ride price up, right? We just ride price up. That is essentially what a liquidity sweep is in its most basic form, right? And that's what we see in price action again and again and again. You see that over and over again. And you don't, listen, I'm an ICT charter student. I've been through literally all of his videos. You don't need anything apart from this, like liquidity sweep and then any entry after retracement. You don't need a market maker model. You don't need inversion fair value gaps. You don't need any of that. You don't need any of that. You need simple trading that you can trust. So this is all we need, right? This is all we need. This is our fake stop run. So let me just make this clear. This is our liquidity sweep right here. Right here is our liquidity sweep. So let me write this out inside so it's super clear. So liquidity sweep, and we always wait for this before we enter, right? Liquidity sweep. You can call this a stop run as well, right? So that makes it easier for you. Let me just make this very quick. Because some people are just gonna be like, and they just don't like the term liquidity, right? You can call this a stop run. Just make this up. So it comes down like that, right? You can call it a stop run, whatever you want to call it. Liquidity sweep, stop run, and what it is, it's just a fake move in the opposite direction, purely designed to grab stop loss orders, right? So it could be a liquidity sweep or a stop run. The exact same thing. As long as you understand what it actually is, and the reason why this works is for smart money, this entity that has billions of dollars to get into the market. And there's two things they need to do. They get the majority of their orders on the higher time frame, right? On the 4-hour, daily, weekly. That's why we look at the higher time frames for liquidity, because that's what smart money does. The second thing they do is they don't, like, the humans don't trade the lower time frames. Their algorithms, their bots trade the lower time frames. This is why some of you might be thinking, okay, how many stop loss orders are there realistically at this low, right? Like, who's going to put their stop loss orders in? Me and you probably won't, but algorithms are coded to put their stop loss at highs and lows, right? Like, at lows here, highs here. They're coded just to do that, right? So their algorithms are literally, they have a 51% win rate and a 1 risk reward ratio, but over like 1 million trades. That's a lot of money, right? But these are algorithms that just, they're coded to fire trade. So smart money, their algorithms are designed just to take out stop loss orders, and then buy, right? So what that means is, let me just move that there. What this means is we've had our liquidity sweep, we've had price quickly move off in the opposite direction. And this is so important. People ask me like, is it a liquidity sweep around here? What if it keeps going down? No. It's only a liquidity sweep when price massively moves off in the opposite direction. That is when it's a liquidity sweep. I don't know, like when price comes down here, I don't know if price wants to come all the way down here. Only when price massively moves off in the opposite direction do I know it's a liquidity sweep, right? Hope that makes sense. Only then do I know it's a liquidity sweep. And then I'm just looking for any entry. Any entry afterwards will do, right? And this is so important, is we wait for a liquidity sweep. Right, we wait for a liquidity sweep. And this is so important because so many people, they don't understand what a liquidity sweep actually is, right? We're bearish, we zoomed out, we saw the higher time frame trend like this, right? We know the trend is bearish. We just want to follow the trend like this. So we're looking for a bearish liquidity sweep, right? Now, a bearish liquidity sweep would look like this. It would look like this, right? Suppose we've got some high here, right? We know there's going to be lots of stop loss orders here because people are going to go short. Our price comes up, it takes out this high here where stop loss orders would be, and it quickly moves down like that, right? And then we want to enter on a retracement. That right there is the highest probability short entry you'll get in all trading, right? And then you just reverse it when you're bullish and stuff. So you've got your stop loss there, price comes up, takes out the stop loss orders, quickly moves in the opposite direction, and then we enter on a retracement, right? That's what we need. And if you get that on the 15-minute chart, that is such a money maker. It's honestly such a money maker. And I don't know if you can see, but right here, we have that exact same thing. So here we've got essentially London's high, right? Textbook, London's high, loss of liquidity at this high, price moves down, and then during New York, price comes up and takes out this stop loss orders here. So let's mark this out, right? Like this, price comes up, it takes out this high here, London's high, where we know lots of stop loss orders are going to be, and then it starts to move down, right? Starts to move down like that, right? So the first thing we look for is our liquidity sweep, right? So let's mark this out. We look for our liquidity sweep like this, nice and easy. So we're just going to mark this out, liquidity sweep, right? And here's the thing, any entry after a liquidity sweep is so high probability, and it's probably the highest probability you'll get in all of trading, right?
Okay, but there's also another part of liquidity that most people get completely wrong, and that is liquidity sweeps, right? Liquidity sweeps are so important because for years I understood liquidity, right? I could get the direction of the market. I knew that price would come and take out these highs, all these lows where there would be lots of stop loss orders, but I couldn't make money with it. I could not make money with it, and it was all because of one simple thing, liquidity sweep. So what is a liquidity sweep? A liquidity sweep simply is a stop run, right? So think, where would people have their stop loss orders? Right? And I'm just going to show you this on the daily chart, but it's not that important. It's just, I just want to give you an example, right, before we get in the lower time frames, because it's so important on the lower time frames. Because if you don't wait for a liquidity sweep before you enter, you're going to get your stop loss hit. So can you see, remember this is the daily chart, can you see this low here, right? This low here is going to have lots of stop loss orders at it because it's a previous day's low, right? People are buying gold. We're in the bull market. People are buying gold. They're going to move their stop loss orders up to each of these lows on the daily chart. And then what does price do, right? Let's study this. What does price actually do? It comes all the way down. It wicks all the way down just enough to take anyone who had their stop loss orders here and then shoots up aggressively in the opposite direction. Like I literally have to zoom out of the chart because we've moved all the way up. It shoots all the way up. And where's it going towards? This liquidity pool here, right? That means that smart money, they force price down just to take out stop loss orders before quickly shooting off in the opposite direction. When you see that in price action on any time frame, right, when you've got liquidity and you've got a liquidity sweep and price shoots off in the opposite direction towards that liquidity, that is one of the strongest signs in price action. That is one of, by far, the strongest sign you can get in price action, at least that I've discovered in 5 years. And this is my exact trading model, because once you've got liquidity and you've got your liquidity sweep, all you really need is your retracement. Enter on any entry pattern you like around here and ride price up.
Okay, so run the lower time frames now, and I'm on the 1 minute chart. You can use this, the liquidity sweeps will be on literally every time frame, but the lower the time frame, the more liquidity sweeps are. That's why I'm on the 1 minute chart, because let's say you're on the 5 minute chart, you can't see liquidity sweep. Go to the lower time frame and wait for one. Now, what a liquidity sweep is we know the higher time frame direction. Like we know, we looked at liquidity is all the way up here, right? So we just want to trade in this direction. Like we just want to look literally any sort of opportunity to get long, right? We want to buy the dip essentially. But that alone isn't enough, because how many times has this happened? Right? How many times have you tried to buy the dip, like on fair value gap, order block, VWAP, and EMA, and the price comes down, it takes out your stop loss here, this is where your stop loss is, and it goes straight to your take profit. Like that used to happen to me all the time, and it's so annoying. Now the reason why that happens, and this held me back for 4 years, this is the reason why I couldn't make money, because I had no idea about liquidity sweep. The reason why is we need to wait for something called a liquidity sweep. So what a liquidity sweep is, I'm just going to show you for this blue line here. So let me just show you here, right? Let's imagine this is where people would put their stop loss orders. What you're going to do is you're going to wait for this stop loss here to get hit, and then you're going to wait for price to show you that it's bullish, and then we're going to enter on a high probability retracement here, right? Because if price came, take out this stop loss, very, very unlikely that price can come all the way down and take out this stop loss again, and then go that way. And I'm going to show you what that looks like in the candlestick charts. But let's just remove this, and then what we're going to do is we're going to the 1 minute chart here. So if you can see, you remember what I just showed you up there. Right now, we know we're bullish, right? So this is the most important part. We've got the direction. We're not even looking for shorts. We're not looking for any opportunity to get short. We're just looking to get long, right? And we're waiting for a liquidity sweep, right? Almost like a snagger. We're literally waiting for it. We know what we're looking for, and we're waiting for it. Lots of people, and if you don't know what a fair value gap is, that's fine. Lots of people are going to start selling when price gets this fair value gap, because they have no idea about liquidity on the higher time frames. But you guys, you watched the video, you know exactly what liquidity is. So we know we're bullish, and what's actually happening is at this low here, lots of people, as euro goes up, they're going to be buying, and they're going to put their stop loss right here, because that's what everyone says, say stop loss, put it at the old low. So at this low here, lots of liquidity, and what we see is price has gone off all the way like that. It comes down. Look at these wicks here, right? Look at the wicks here, and I'll make it a bit more obvious. It just wicks below this low here, taking out anyone who had their stop loss orders at this level. Anyone who had their stop loss around this level here, right? It price wicks down, takes out their stop loss, and then quickly and aggressively moves on, right? Literally so aggressive. I have to zoom out of the chart, right? It goes all the way up there in the opposite direction, right? That right there is what we call a liquidity sweep, right? That is what a liquidity sweep is. Now, I'm going to show, let me just get this really obvious, right? See this wick here? This wick here is your liquidity sweep. At this low, people have their stop loss orders, right? Because price went all the way up. This wick literally pokes down, takes out anyone's stop loss orders who are here, and then massively and aggressively moves in the opposite direction. Now, the reason that happens is because smart money, right? Big banks, big hedge funds, their algos, so an algorithm, right? Trading bot is coded to enter at these stop loss, right? So at key highs and key lows, as soon as price comes, but I think it's like, I don't want to get too much into that, but it's something to do about the standard deviation or like Fibonacci or whatever. But as soon as price takes out these old lows or old highs, they're buying. They're buying because they know people can have their stop loss at this low, at these highs. The price comes down, takes out their stop loss. This is where my stop loss used to be, where your stop loss used to be. People will think, oh, there's an order block here. I can enter on this order block. Price comes, takes out your stop loss, and then goes in the opposite direction. Now, what we want to do, if you remember what I showed you on, with the blue line, so what we want to do is we've got our liquidity sweep, we've got the higher time frame liquidity all the way up here. All we want to do now is we want to enter on some sort of retracement. So we've had our liquidity sweep. This was a liquidity sweep. Price has clearly shown us that it's still bullish, right? It's not just consolidated for ages around here. It's not gone like this. It's shown us clearly and aggressively that price is bullish. At this point here, we want to start to enter on our trade, right? We want to look for some sort of retracement anywhere, at this point here.
Okay, so we're in the lower time frames, and most people understand what I just said in the higher time frames. They know we're bearish, but they always go wrong in the lower time frames. Now, why did they go wrong? because they're not waiting for a liquidity sweep. Now, what is a liquidity sweep? And a liquidity sweep is, a liquidity run, liquidity grab, whatever you want to call it. It's the exact same thing. What it is we know we're bearish on the higher time frames. We've done the hard work, which is always on the higher time frames. We know the actual direction of the market, and we're looking for any reason to get short. Now, we're waiting for some sort of key high to be taken out because we're bearish. Now, why are we waiting for that? We know, right, and you've probably had this loads of times where you might have shorted here, right? You might have shorted at this order block, let's say. So this order block, the last up close candle followed down move, you might have put your entry right at this body here. You would have had your stop loss maybe up here, and you would have targeted maybe this wick's low, like a 3 to 1 or something, right? How many times have you had the bias right, the direction right, the price literally will come down, go straight through to your stop loss, take out your stop loss right here, and then quickly reverse? Like, how many times does that happen? Because that used to happen to me all the time for years. Like, I would get the bias right, I knew exactly where it was going to go. Price would come, it would literally wick up, take out my stop loss, instantly reverse. The reason why that happens is because you're not waiting for a liquidity sweep. Now, what is a liquidity sweep? We know at this high here, there's lots of stop loss orders here. Lots of people have gone short on gold. They know from the higher time frames that we're bearish. So they've got the stop loss orders here. And I'm going to mark this out, right? Because this is so important. When price comes all the way like that, right? See this wick here? See this wick? So let me make this more obvious. See this wick? You see how it points up? Literally comes out, takes out this high. Let me make this a bit more clearer. Right, comes up, takes out this high, instantly reverses. Look how aggressively we reverse. That right there is your liquidity sweep. Right, it pokes up, takes out the high, quickly reverses. That is your liquidity sweep. And this is really important. We don't know it's a liquidity sweep until around down here, right? Because once the wick comes and takes out the high, it is possible the price could have had a little retracement and continued up, right? But when we see a wick that just points up, just takes out that high, and then quickly reverses sharply, that right there tells you you've got a liquidity sweep, right? And what we really want to do is we want to enter on that retracement after the liquidity sweep. So I'm just going to mark out the liquidity sweep here, because you always, and this is so important, if you're a day trader, scalper, or even a swing trader like I am, you want to wait for a liquidity sweep before you enter, because if you don't wait for a liquidity sweep, you're going to get swept. So I'm going to mark this out, liquidity sweep. Right, and this is probably the second most important thing. Once you've got the bias, you need to wait for a liquidity sweep. Otherwise, you're going to be getting your stop loss taken. You're going to be right with the bias, and then you're going to lose, and then you're going to get angry. You're going to revenge trade, and you're going to keep losing and blow your account. All these things happen to all traders, and I don't want you to go through that. So we wait for the liquidity sweep, wait for the wick to take out the high, and then we're just looking to get short, right? And this isn't a video about entries. We've got loads of entry videos on the channel and stuff. But now the second part of liquidity, and this took me another year, right? I understood liquidity like fairly well. You know what I just did in the higher time frame, and lots of people do understand that, and they can get the direction right, but they always botch the entry. Now, when I say botch the entry, what I mean is they know we're long and they're looking for any sort of retracement. The price will come down, take out their stop loss orders, and then quickly move to that take profit. Right? Like, how annoying is that? I used to happen to me all the time. All the time, I'd get the direction right, price would hit my stop loss, and then quickly go to my take profit. And it all happened because of one reason. I did not wait for a liquidity sweep. Now, a liquidity sweep is the most important thing in trading for your entry, right? If you have an entry pattern, you need a liquidity sweep, because without a liquidity sweep, it's very hard to make money. Very hard to make money consistently, because you'll just keep getting stopped out, and it'll be so frustrating for you. But what a liquidity sweep really is, it's a fake stop run. So right here, got a lows here. You see these wicks? I mean, it's very clear. Right here, let me just move this down. Right here, there are going to be stop loss orders. Lots of people trying to buy gold, right? It's at all-time highs. Or it's going towards all-time highs. People can be buying, trailing their stop loss orders here, and they can price and keep going up and up and up, right? So right here, there are stop loss orders, right? Now, it might not be like billions worth of stop loss orders because we're on the 5-minute chart, but there are enough stop loss orders for smart money to target them. Now, do you notice, right? Do you notice how price moves off, right? So with bullish, price comes down. It just about, look at the wick, right? Look how it just wicks below it. Picks out anyone who has their stop loss orders here. Picks out any stop loss order and then quickly shoots off. That right there is a liquidity sweep, and that is the highest probability entry in trading, right? And once you've got your liquidity sweep, like we have here, any sort of retracement afterwards is so high probability. I mean, you ride price up in the higher time frame and liquidity direction. That is the highest probability trading model in all of trading, and it doesn't matter on the retracement what you enter on. You could enter on a fair value gap, order block, optimal trade entry, or even an indicator, right? It really does not matter as long as you've got this entry pattern where you've got a fake stop run, right here. It's a liquidity sweep. Now, liquidity sweeps are so important because so many people misunderstand it. A liquidity sweep, let me just write it, it's a fake, the fake move, right? That's what it really is. It's a fake move and it's a stop run, like that, right? That's what a liquidity sweep really is. Let's just make this a bit smaller. The thing is with a liquidity sweep is it only matters when we know where price wants to move on the higher time frame. That's why we did all the work on the daily chart, right? Because if I never looked at the daily chart, I'd have no idea if this was a liquidity sweep or if this bit here was a liquidity sweep. I'd have no idea. I'd have no idea because I'd be trading completely blind. But because we did the work on the higher time frames, and this is why I say we always need one higher time frame and one lower time frame. I think the daily chart and the 5 minute are so easy. We just combine those two. It's so easy. Or if you really want to, you want to be more active, you can have the 4 hour and 5 minute or the 4 hour and 15 minute, or even the daily and 15 minute. But you've got to have a higher time frame for liquidity and a lower time frame for your liquidity sweep and entry.
Okay, so now for the fun part, we've got our direction. We know that liquidity is all the way up here on the higher time frames, right? That's where our direction is. That's where price is most likely to move. So I'm now on the 1 minute chart, and you can use it. Someone's asking me, hey, why are you on the 1 minute chart? You can use any time frame for your entries, right? So as long as you've got the liquidity, you've got the overall direction. It doesn't matter whether you use the 1 minute, 5 minute, 15 minute chart, or even the 4 hour chart, right? When I swing trade, I use the 4 hour chart using the exact same logic. So it doesn't really matter what, time frame you use. The only thing that matters is that you've got the overall liquidity, you've got the overall direction, and then that you wait for a liquidity sweep, which I'm about to talk about now. So what a liquidity sweep is let's say we've got the overall direction, which we have, right? We know we're bullish, right? We know that price is going to go towards these highs here, right? We know the direction. Now, most traders, they can understand, at least they can identify where the obvious liquidity is, right? They can understand, okay, we're bullish, there's key highs that price is likely to go towards. But what they get wrong, and what I got wrong for about 2 or 3 years, is I didn't know where to put my stop loss, because what would happen to me is price would move up towards these highs here. On the retracement, there'd be, let's say, a fair value gap or an order block. I would buy around here, put my stop loss here, thinking I was nice and safe. Price would come down, it would take out my stop loss, and it would go straight to my take profit. Or even worse, it would give an even better entry right here, and it go straight to my take profit. Right, that happened to me consistently for years and years and years. And I could get the liquidity right, I just couldn't get my entry right, and I never made any money. And I lost so much money, and I went through so much pain. So I want to save you, I guess, the pain of going through that. And the way you solve this issue, and what I figured out, is you need to wait for something called a liquidity sweep. Now, a liquidity sweep is just a fake move designed to take out stop loss orders. So in this scenario here, we're bullish, right? We're bullish, and we're targeting this liquidity bull here. This liquidity, these stop loss orders here. This move here, you see how price comes down, it takes out stop loss orders here, and it quickly moves off in the opposite direction. That right there is a stop run. Now, the reason we know it's a stop run is because, first of all, we know the overall direction of the market is bullish, right? That's the first thing you need to know. You need to know the overall direction, right? So we're only going to look for longs, right? We're forgetting any, opportunity to go short. We're only going to look for longs, right? So price coming down, price being bearish, first of all, we're going to think, hang on a minute, price is actually bullish on the higher time frames. Why is price coming down? Is it to either give us an entry or is it a liquidity sweep? So price comes down, takes out the stop loss orders here. Now, I don't know at this point here, I don't know if price is going to reverse or not. So I'm not buying here. Now, some people, they will buy as price is taking out these stop loss orders here. That is called a turtle soup. So you might hear people saying, oh, turtle soup and stuff. Trust me, do not look at that at all, because that is very, very advanced, right? If you're buying stop loss orders, you need to have a lot of experience. Even I, with like 4 or 5 years of trading, it's very, very difficult, because you're going to have some big balls to start buying stop loss orders, hoping that price reverses, because if it doesn't, you will lose money very, very quickly. So I always say to my students, wait for a liquidity sweep, wait for the price to move off in the opposite direction, in the overall direction, telling you that you are right. Right? That's how we know it's a liquidity sweep. I don't know it's a liquidity sweep here. I only know it's a liquidity sweep as price starts to move off in the opposite direction, and ideally starts leaving fair value gaps. So I'm going to show you what that looks like on the 1 minute chart. Okay, so now that we've got our liquidity on the 4 hour chart, we get onto our entry time frame. Now, whatever time frame you trade, doesn't matter. And for me, I'm just going to show you an example on the 1 minute chart, but it's not enough, and this is super important. It's not enough just to buy the dip, right? We can't just buy a random retracement like this, hoping that price will respect some sort of fair value gap, order block, and continue upwards to liquidity, because that is not how these markets move. That is not how these markets move. I don't know if anyone's actually told you how these markets move, but when we're bullish, what price actually does is it will come up, it will come down, it will take out some old low where there's lots of stop loss orders, right, taking out all of retail traders. Then it will move in the other direction, and then and only then will it give all of smart money traders, those in the know, high probability retracements to enter on right here, and then it will shoot right off, right, to take profit, right, just like this. So there will always be, super important, there will always be a stop run. There will always be a stop run before you can enter, and that is referred to as a liquidity sweep, which you might have heard. But what most retail traders do is they'll buy, and this was me for years, they'll buy the dip, right, they'll buy as price comes down, they'll put their stop loss this low, and they'll target all the way up here, only to see price come down and take out their stop loss, right? That is not what you want to do, right? Because you'll see that all the time in price action. Instead, what you want to do is you want to enter after some old low's been taken, right? So you want to enter here, put your stop loss at the old low, that was a liquidity sweep, and then target your 2 or 3 risk to reward ratio.
Because it's not enough to get the direction right. I had the direction in the market. Probably within a year in trading, I had it nailed down. I could always, 90% of the time I get the direction right, but I made no money because I didn't know where to put my stop loss. Right? I had no idea where I was going to put my stop loss orders, and it always got hit. So what we're going to do is we're going to wait for something called a liquidity sweep. Now, it'd be easier for me to show you on this little blue, line chart, what liquidity sweep is. So we know we're bullish, and let's suppose you're bullish, right? Typically, you want to buy the dip, right? You want to buy any sort of retracement here, whether it's a fair value gap, order block, VWAP, any sort of indicator, anything telling you to buy. You want to buy the dip, right? You want to buy price when it's cheap. Now, what probably happens, and this probably happens to you all the time, is that price has come down, it takes out your stop loss right here, and it quickly moves straight to your take profit, or it gives you another entry and goes straight to your take profit, right? The reason it does that is because you didn't wait for something called a liquidity sweep or a stop run, right? That is what a liquidity sweep is. It's a fake move designed to take out your stop loss orders and, whoever else has their stop loss orders there, and then quickly and aggressively move off in the opposite direction. So that is what we wait for, because once you wait for a liquidity sweep, any entry after that is so high probability, it's insane. And right here, and this is so important, this is probably the most misunderstood thing in all trading. Right here, we have something called a liquidity sweep, right? Now, a liquidity sweep is essentially, now we know that we're bullish, we did the work on the higher time frames. Essentially, let's say we have some bullish price move up, right? Price comes down, it just wicks down, takes out your stop loss, and then instantly moves off in the opposite direction. That right there is a liquidity sweep, right? It was a fake move. This move here was a fake move designed just to take out stop loss orders. And then any retracement after a liquidity sweep, right, is super high probability. So we want to enter any point around here, right? Very safe place to put your stop loss here because it's already taken out stop loss orders. Then you want to ride price up. That is what liquidity is as like a basic overview. And it's literally the best entry in all trading, right? I've traded for years, 4 years. I'm an ICT chart student. That is the best entry in all trading. It took me at least 2 years to figure this entry out. And then it took me years to actually master it. But nevertheless, here we are, right? So right here is a liquidity sweep. You see, let me just make this clearer. You see how price comes down, it takes out an old low, quickly and aggressively moves off in the opposite direction, right? That is our liquidity sweep. And then any retracement after that is high probability. Now, you might be asking, let's remove this. You might be thinking, oh, well, there's probably not much, not many people are going to have their stop loss orders at this amount. Now, you're going to be right. There might not be many people who have their stop loss orders here, but there are so many algos that are coded to put their stop loss at key high, or not at key highs, at any high, any swing low, right? They're coded just to keep buying, keep buying, selling out, highs and lows. That's, 70% of the volume of these markets are all algorithmic, right? So there are algos that are literally 51% profitable. Their win rate's 51%, and they get a 1 risk to reward ratio. But they make like 1 million trades in a day. So, over the long run, or over 1 million trades, they are like quite profitable. But anyway, at highs and lows on any major financial market, like gold is one of the most highly traded markets. There are spots that are at every high and every low. So there is liquidity here, right? Now, it's not as much as like the 4 hour or daily chart. There is enough liquidity here for it to be a liquidity sweep. So right here is our fake move, right? Fake move. Look at this wick. This wick only comes down to take out this low, and it instantly and aggressively moves off. It's literally gapping, right? We've got a gap here. Price is literally gapping up just to move off, right? That is our liquidity sweep. That is the best thing we want to see in trading, especially when we're bullish. So we've got our liquidity sweep. Put that there. We've got our liquidity sweep. Price quickly and aggressively moves off in the opposite direction. Now, I don't look at marking structure, but if you do, here's your marking structure shift, right? Let me just mark this out. I don't look at market structure because I think it's a bit of a distraction, because liquidity is all you need. The moment this body essentially, or this body really, once it closes above these highs, that's your market structure shift. I don't look at it personally, but if you want to, there's another thing that will add to the probability. And all you need is any sort of retracement afterwards. Once you've got this whole framework of liquidity on the higher time frame,
That gives you your direction. Liquidity sweep on the lower time frame, price has moved in the higher time frame direction. Any entry pattern after that, any entry pattern on the retracement will do. So I'll give you literally 3 entry patterns here. So we've got a fair value gap. It's just the gap between this candle here and the candle there, right? The gap between this candle and this candle. That's a fair value gap. You could enter on that fair value gap, right? That could be your entry. You could, I mean, look at this, right? Look how it's always beautiful, isn't it? Look at how the bodies are like holding in the fair value gap, right? Look at that. And then the wicks are doing, are like poking out, right? This look for your notes. The wicks do the damage and the bodies tell the story. The body is smart money. The wick are retail, right? These are retail traders randomly buying and selling for no reason. Because they only look at the 1 minute chart. Smart money are the bodies, right? The body is smart money. So yeah, it's pretty interesting how like the price was just holding in that fair value gap. Like it wicks out, but the bodies are in the fair value gap. But anyway, doesn't matter, right? Another entry pattern can be this little gap here. Now, for those who know, this is called a volume imbalance, or at least I call it a volume imbalance. Now, this has so many different names. Someone on Twitter was asking me about this. I had no idea what he was talking about, but he was actually talking about this. Does not really matter. This is, you very rarely get this, right? You very rarely get this entry pattern here. So, I would personally say not to have that as your entry. But what I would say is this right here, this volume imbalance, where it's just, see these 2 wicks and there's no bodies overlapping. I'm going to try not to put my cursor on it because it does that thing, but you know what I mean, right? You know what I mean? See these 2 wicks overlapping because there's only wicks overlapping and there's not like a body that there is for a fair value gap. That means that volume imbalance is a stronger draw than a fair value gap. Now, what that means is that price is more likely, it's more likely to come to this volume imbalance than it is to a fair value gap, right? A volume imbalance is a lot stronger than a fair value gap. It's a lot more important. So that's what it's a bit interesting, but it's not really that important. The last entry, and I think this is probably the best entry, just by looking at the price action, if I was on the chart, is you see this order block here. The last down close candle before the up move is your order block. Now, there's 2 ways of entering on the order block. The first is the wick, right? So people could, let me just mark this out, right? People could say this entire thing is the order block, right? And then they could enter right at the wick high and put their stop loss. You'd have to put your stop loss at liquidity sweep low, but they would say that's an order block. That's true. You can enter on that. Me personally, I always like the bodies of an order block, especially when it's quite a big body. The only time I'll ever use the entire order block candle is, let's say it's a doji. Let me try and draw a doji out, right? Let's say you've got like it's gonna be awful in it, but let's just imagine like this was like the body, right? The body was like here, a tiny little body, and it had like, it's got huge wicks. Like if it's a huge doji sort of candle, then okay, by all means, use the whole thing. But right here, the body is the most important part. So for me, I'm just gonna enter like this, right? On the order block body. Now, for your stop loss, it's so important. The stop loss always has to be at liquidity sweep low. Always has to be there. Because I always say this, but I'm going to keep saying it so everyone watching this is profitable. Very, very unlikely, right? At price, because price came down, just take out stop loss orders and then moved up. Very unlikely price going to come down, take out stop loss orders again, where it's already done that. The whole point of price coming down here was just to take out stop loss orders. It's very, very unlikely that price is going to come all the way down, take out your stop loss, and then move all the way up, right? That is the power of waiting for a liquidity sweep. Because how many times, this used to happen to me for years, let's say you were bullish on the higher time frame, you kind of understood liquidity, right? You kind of understood, okay, I just target highs and lows on the higher time frame. It's pretty easy. You get the direction, right? Then you'd buy as price comes against you. Price would take out your stop loss and then instantly go to take profit. The reason that happens, and it's so annoying, is because you don't wait for a liquidity sweep. So once you wait for a liquidity sweep, you're good to go. So any entry pattern will do. Stop loss always at liquidity sweep low. And then the take profit. For me, I always say this, I just aim for a 3-to-1. I never aim for more than it. You can, if you're on the 1 minute chart, I guess you can, right? And if I was on the 1 minute chart, just looking at this price action, I would aim for this high here. Right, I'd aim for this high here, right? Lots of liquidity at that high. And let's just aim for this high here. What do we get? We get about almost a 5 risk to reward ratio. Now, I'm not advocating like to always, aim for like a 5-to-1. But, if you were doing like a prop room challenge or what the past in a week, not the worst idea in the world, especially when you've got all this framework behind it. Higher time frame bias, lower time frame liquidity sweep, and obvious strong liquidity. You can do it. And this is so important, right? The only thing I'll say, right, is do not aim, let me just remove this. Do not aim for the key daily target, unless it's really like, if it's likely for the day. Do not aim on the 1 minute chart to try and target this, right? Because it's insane. You don't need to do that. The only reason we use the daily chart or the 4-hour chart for liquidity is to give us a direction, right? That's it. Now, if price was all the way up here, then yeah, by all means, just target it around the 1 minute chart. But price is all the way down here. Don't hold for like, weeks trying to get to this position. You don't need to do that. You just need a free risk to reward ratio. And for me, because I think that's like the golden zone, but with this strategy here, you can get an insane win rate, absolutely insane win rate. And the good thing is, if you're on the 1 minute chart,
I mean, you can almost find a setup every day. Now, I'm not saying to trade every day, obviously, but you know, you could find a setup almost every day. You don't have to. And so many people get this wrong. They try and finesse the entry. They ask, hey, what breaker block do you use? Do you use inversion Valley Gap? You know, IGT's released this new PD array. You don't need any of that. All you need is a liquidity sweep and a simple entry. And I'm going to show you, and I guess I'm just going to show you a few entries actually, just because. And there's 3 entries that I always vouch for. If you watch this channel, and for a while, there's 3 entries which I love. I call them the 3 golden entries, and they are the optimal trade entry, the order block, and the fair value gap. Now, I'm literally going to give you each one an example of each one on this bit of price action here, right? If that makes sense, because any entry pattern will do. But for me personally, I just take a Fibonacci retracement or an optimal trade entry, which is I put my Fibonacci, and to get the Fibonacci right, all you need to do is come to the top left here, right, and then on your indicators, just look for Fibonacci retracement, not this one, Fibonacci retracement like that. And if you press start on TradingView, you can get it. You can get it here, right? Same thing with the risk to reward tools here. So for those who are asking, some people still do ask me this. You want a long position, you come on the projection part, long position, short position, press the star, right, the star here, and then you'll get it here, right, like that. So nice and easy. Anyway, so what you do, right, is you enter like this, right? You enter like this, right, like that. That's your entry. You put your stop loss at the low, and then you target a free risk to reward ratio like this, right? You guys get the point. Now, some people are going to be asking me, they're going to be asking me, oh, and I'm going to keep saying this, oh, you know, should I put my stop loss here? Should I put it here? Should I put it at this fair value gap here? At the, you know, the low, the order block? You always put it at the low where the liquidity sweep was, right? That's the whole point in waiting for a liquidity sweep. Like, why would we wait? Keep asking yourself this. Why would we wait for a liquidity sweep? Right? Why would we wait for a liquidity sweep if we're not going to put our stop loss low at the liquidity sweep? Like, what's the point in that? Like, why would we put our stop loss here? Right? The whole point of waiting for a liquidity sweep is that we can put our stop loss order, or at least our stop loss, in the safest place possible. Very safe, because very unlikely, if this was really a fake move designed to take out stop loss orders, that pricing would come all the way up here, come all the way down again, just to take out more stop loss orders, and then move off. Very, very unlikely that's going to happen, right? But that's why we always put our stop loss orders right at the low of the liquidity sweep, right here. We always put it there. We don't, you know, we don't try and get some crazy risk to reward ratio. We put it at this level. It's nice and safe. And then I'm a big believer in this. Just aim for a 3-to-1, right? You don't need a 4-to-1, and you can aim for a 2 risk to reward ratio. But for me, I just aim for a 3 risk to reward ratio. And let's just replay this, right? I know a lot of you are going to want to just see what it looks like in live price action. So imagine this is price action live, right? You're on the chart. This is what I'm looking for. Now, some people might be asking, oh, you know, there's another little swing low, swing high here. Look, listen, I can tell you from years of trading, just ditch market structure. Please just ditch market structure. I have so many students, right, who understand liquidity. They finally understand liquidity sweep, right? And they're like, they see price action like this, and oh yeah, you know, oh, I'm going to enter. And then they don't enter because there's some sort of market structure shift on the 1-minute chart, or this swing low was taken. Honestly, just completely forget about market structure. I know it might be hard and stuff. Just forget about it. It's a waste of time. It's a complete waste of time. Goldman Sachs aren't buying because there's a market structure shift on the 1-minute chart, right? They only buy because of liquidity on the higher time frame, and we just trade that direction. So ditch market structure. So it's so many people DM me. I'm not even joking. So many people DM me. They get this right. They would have made money, and they keep telling me, oh, I didn't take the trade because I was afraid to lose. I was afraid because of this market structure shift. Ditch market structure. All you're going to do at this point, set your limit orders here, right? So you set your limit order, you enter at the 0. Let me make this very clear. You enter at the 0.705 level. This level here, right? That's all we care about from Fibonacci. This level here, we're going to enter on. You can remove the 0.5 level. You can remove all these. All we care about is the 0.705 level. Then what you're going to do is you're going to put your entry here, stop loss here, take profit here, and you're just going to wait. If price, and people are going to ask me this, if price breaks this high, or it comes down here, right? So it breaks up this high. Then I'm going to put my Fibonacci at the new high, right? If that makes sense. So what I would do is I'd move the Fibonacci like that, right? Nice and easy, right? So it's not nothing crazy, but we're just going to wait for a retracement. So let's just play price action like this, right? Like this. And this is real trading. I want to give you guys a real example. Not every trade is going to come like this, right? And go straight up, right? If these gurus are lying to you, let me tell you that. Listen to me right here. This is a real trade. You're on the 1-minute chart, right? You've got a bit of retracement. Lots of people are going to panic here. They're going to panic here. But I just let price do its thing, right? We hit take profit. Let price do its thing. It's the 1-minute chart as well, guys. So literally, this is like an hour, right? You're risking 1K, you're going to make 3K in an hour, right? Who's angry with that? So, you know, this is real trading, guys. Real trading. You're going to have some consolidation. Price going to chop around for a bit before it hits your take profit. Key thing is, don't get emotional. Don't start taking partials. For those who ask, I don't use partials. I do move my stop to break even once price breaks this level here. So once price comes up to here, I move my stop to break even like that, right? Like that. But I still my free was toward take profit, but my stop loss goes to break even at this point because almost always it hits my take profit. Maybe like 1 in 20 times it will come back and hit, I guess, my stop loss. So yeah, that's the optimal trade entry. I'll give you the order block and fair value gap entries now. Okay, so for the next example, we're going to use an order block. Now I'm not going to do the replay and stuff. We don't need that. But this right here, let me just mark it out. The last down close candle before the up move is your order block, right? Last down close candle before the up move is your order block. Now first of all, just look at this, right? Look at that. Look at the wicks respecting. Look at the bodies respecting this order block there. And how crazy is that? That's absolutely insane. Wicks tap in and then quickly move off. Now people ask me this all the time, right? A high probability order block, price will do that. It will tap up. It will tap it and then quickly move off in the opposite direction. A low probability order block, price will do this. It will deeply retrace, start consolidating a bit, and then slowly move out. That is a low probability order block. We don't want to do anything with that, right? That is a low probability order block that we want to avoid. Now, in terms of entry, this is literally the highest probability order block you can get in all trading. You have a liquidity sweep and you've got a fair value gap attached to it. It does not get cleaner than that. So what we're going to do is we're just going to enter like this, like this. I'll stop loss at the low. And then for take profit, I would say obviously at least a 3 risk to reward ratio. And look, listen, if you want to like pass a prop room challenge and you're willing to take the risk, aim for this high here. Right, aim for this high here, right? We're on the 1 minute chart. It's quite likely, if we're bullish, that we're going to hit this high here. So, if I wanted to pass a prop firm, and I'm not advocating to do this every single day or every single time, but if I really want to pass a prop firm, I wanted to make a lot of money and I was willing to take the risk, by all means, go risk 1% on this trade here, and you probably get it, I'd say 9 times out of 10, with all this framework, right? With the higher time frame buys and liquidity sweep. Yeah, and then for fair value gaps and fair value gap entry, what we're going to do is you're going to enter this fair value gap here. Now, let me just make this clear. See, price doesn't even touch it here, so we are good. If price did touch it here, so let's say if price touched it like around here, what we would do is the bit that's remaining would be our fair value gap. But we're okay in this case. This is our this is our fair value gap, right? This is our fair value gap. Now look, right? Price wicks below the fair value gap because it's quite narrow, but it's wicking into the order block. So we are okay with it, but anyway, you wouldn't know that in hindsight, right? You're not going to know that price is going to do that. You're just going to buy as it comes down here. And this is why I'm a big believer in not having such a tight stop loss. Because so many people are like, I put my stop loss at the fair value gap. Like, why? What? The whole point of waiting for this liquidity sweep is to put our stop loss in a safe place where we know it's very unlikely the price is going to go to. And then for take profit, what we're going to do is, I wouldn't aim higher than this here. So here we go, 4.3 risk to reward ratio. And if you want an easy take profit, 3 risk to reward ratio, like that. Look at this, right? You entered at 4:21 a.m. and then 4:29 a.m. It's like 8 minutes. 8 minutes, you can make 3K. Pretty good life, boys. Pretty good life. And by the way, people are going to ask me this all the time. This is in New York Eastern time, because this is how the markets operate. So this right here would be a London strategy, but it works in literally any session. So London, New York, and Asia. It works in any session. It works on all markets. It works on Bitcoin, because I know a lot of people, but there's a few people are really interested in crypto. It works on crypto. This exact same thing. Forget gold, right? Forget this. Just put like a marker over this, and like a black marker over this and this, and this concept would work. This concept works on any time frame, and it works on any market. Look, don't overcomplicate it, guys. Don't ask, I've only seen examples on gold, but does it work on GBP, JPY? Yeah, it works on all markets. So yeah, liquidity sweeps may be profitable instantly, and they will make you profitable. It's honestly the highest probability thing I've ever seen in trading, and I've taught so many students this, and they've made money right away. But the next thing we need to do is we've had our liquidity sweep. We know we're bearish on the higher time frame, or at least on the 15-minute chart, right? Which is all we need for this model. The next thing we do, and the last thing we do, is we just wait for a bearish fair value gap, right? We want a fair value gap that forms in the trend direction, right? That easy, that simple. So right here, right, this is our fair value gap. This is our fair value gap. We've got our liquidity sweep. We've got our fair value gap, like that, right? That right there is the highest probability entry you can get in trading. Liquidity sweep, we've got the trend, and then we've got a fair value gap that forms in the trend direction. Okay, so now that we've got the fair value gap that forms, all we need to do is enter on that fair value gap, right? So all we're going to do is, let's just go here. So we're going to enter on the fair value gap. Now, for our stop loss, this is so important. People are asking me this on X, right, on Twitter. They're asking me, do I put my stop loss here? Do I put it here? Do I put it at the fair value gap high? You always put it at the liquidity sweep high, right? The whole point in us waiting for a liquidity sweep is so we have somewhere safe to put our stop loss orders. Because how many times, right? How many times does this happen when you're bearish? And let's say you put your stop loss right here, right? Thinking it's nice and safe. Price comes up, takes out your stop loss, and then instantly goes to take profit. The reason that happens is because you haven't waited for a liquidity sweep, right? The whole point of a liquidity sweep is supposed to find a safe place where we can put our stop loss orders, right? Where we can put our stop loss and not have to worry about it. And right here, we put our stop loss at this high here, right? This liquidity sweep high is where we put our stop loss, right? Nice, safe stop loss. And now you don't have to have, and I've learned this after years of trading, you don't need, a really tight stop loss. You really don't need a tight stop loss, right? The only people who have really tight stop losses are those who aren't confident and they have a really low win rate. With this model, you will get a high win rate, and we can get at least a 2 risk to reward ratio, ideally a 3 risk to reward ratio. So right here is your 2 to 1. Right? We're gonna aim for a 2 to 1. Now let's just zoom out a bit and like this, right? Ideally, and I always encourage my students to aim for a 3 risk to reward ratio, like that, right? Nice, easy risk to reward ratio, like this, right? Nice, good risk to reward ratio. And all we're gonna do, let's just move this up. All we're going to do is just play the price action. So your limit order, remember this is a 15-minute chart. So, and this is why I'm a big believer in 15-minute charts. Because first of all, you can see the trend quite nicely, right? So if you zoom out, you can see the trend quite nicely. All right, we can see that we're bearish. And then the second bit is it's not that fast, right? It's not that fast. So it's very easy to read. Very easy to read. I mean, this is so obvious. I mean, I hope it's so obvious, right? You've got London tie, typical sweep in New York, fair value gap that formed in the direction of the trend. All we're going to do is enter on that trend, right? Enter on that fair value gap. So let's just play price action, zoom out and play price action, see what happens. Bam, bam, down. And then we just let price do its thing. Like this, right? Let it do its thing and then bam. Just like that, right? Pick your take profit. Nice, easy trade. Let's see how long this took, right? You went to 8:30 and you were done. Not even 10:30, so like 2 hours, right? 2 hours in a trade. Nice, easy, high probability day trading model. You can do the exact same thing in London and the exact same thing in Asia, right? This works on all markets, works on forex, indices, any market, like literally any financial market, it will work on, right? Because there's 2 reasons. The first is the trend, right? The trend, you can't, like smart money can't hide where price is actually going to go, right? They can't hide where price is actually going to go. So 15-minute chart will give you the trend, direction. Number 2, liquidity, right? Liquidity is the lifeblood of the market. The only reason price moves is for liquidity. And we know that the trend is bearish, the price is moving for liquidity on the higher time frame somewhere. And then we've got our liquidity sweep. This ensures we get a high probability entry. Right? This makes sure that price doesn't come, take out our stop loss, and then go to take profit. Right? That gives us the highest probability entry. And then the fair value gap in the trend direction shows us we're on the right side of the market. Shows we're on the right side of the market, and then we just enter on that fair value gap. We always put a stop loss at the liquidity sweep high, and if you're bullish, you put it at the liquidity sweep. There's a fair value gap here, right? Easy fair value gap entry that you can take, right? So you put your entry right here. To make this a bit more obvious, put your stop loss at liquidity sweep high. Now, why do we do this? We talk about this all the time. Why do we do this? Because it's very unlikely if we're bearish and we've had this liquidity sweep, right? Because remember, price only came up here just to take out that high. That's the only reason it came up there, was just to take out that high. Very unlikely that price is going to come down all the way down here, come up, take out this wick again, and then go back down. Very unlikely. It is possible. It does. The lower the time frame you go, so if you're on the 1 minute, and especially on indices, you'll see that a lot. It's like a double liquidity sweep. But for forex, if you're on the 5-minute chart, very unlikely, right? Because price only came up here just to take out those stop loss orders. That's the only reason it went up there. It didn't go there for any other reason apart from just to wick up, take out those stop loss orders, so smart money could take the other side and ride price down. So it's super unlikely price is going to come all the way up, take out your stop loss, and then reverse. So it's very safe to put your stop loss here. Very safe, right? Very unlikely that price is going to come up. And in terms of take profit, always target at least a 2 to 1. And for me, I say never more than a 3 to 1. Now, why do I say that? Because let's just at least target this low, right? Because lots of liquidity, and you ideally want to be targeting the opposing liquidity pool. Now, what does that mean? It means if you're bearish, you want to target the opposing low. And if you're bullish, I target some opposing high. Really doesn't matter, but for me, a 2 to 3 to 1 is absolutely fine. And if we target this low here, basically get a 3 to 1. Now, why do I say never to trade and never target more than a free risk reward for day trading and scalping, and even swing trading, really? Because look at this. Let's say you target a 4 to 1, right? You did everything right. You got the bias right in the higher time frame. You wait for liquidity sweep here, right? You wait for liquidity sweep. Perfect entry. Price comes all the way down, right? So it comes like that. You enter right here, perfect entry, 3% up in profit, and it just chops like that. And then this is the end of the week, right? So it gaps up, or it just reverses on you, right? Imagine that. Imagine how annoying that is. I'm telling you, all you need is a 2 to 3 to 1 consistently. Right, I have a 50% win rate and a free risk to reward ratio. I'm profitable. I can make all the money in the world, 10k a month, 100k a month, you know, $1 million a month maybe if I get enough capital. Like, I can make whatever amount I want, right? That's all you need. Most profitable traders have a 50% win rate and a 2 or 3 risk to reward ratio. You know, all these guys saying you need, you know, a really tight stop loss, massive risk to reward. You know, it's a load of crap. It's a load of crap. And that's because they have a tiny win rate. If you do this, you're going to get a good win rate. Right, we've got our stop run, our fake liquidity sweep. Now we're looking for our entry. Now, for me personally, this is my entry. Full transparency, I just take an optimal trade entry, which is literally a Fibonacci retracement, because I'm going to keep saying this, the entry pattern is the least important thing. If you've got liquidity, or if you've got liquidity on the higher time frames that we have here, and you've got your liquidity sweep, the entry pattern does not matter. Any sort of fair value gap, order block, indicator, even VWAP, you know, optimal trade entry, Fibonacci retracement, all of them are high probability. As long as you've got liquidity on the higher time frames, you're trading in that direction, and you've got your liquidity sweep. So we're going to enter 0.705 level, stop loss at the low, like this. And for me personally, I just target a free risk reward ratio, like that, right? Nice, easy trade. You guys got the point on your free risk reward ratio, nice and easy. I did this all the time where I was day trading, when I was scalping, and now I do it when I'm swing trading. This model right here is the money maker. It's the model that took me about 4 years to finally figure out. But yeah, this model is so good. Now, let's just let me just tell you a few things, right? Some people always ask me, they say, hey, you know, should I target all the way up here? No, that's not what we do. We do not target that liquidity unless you think within a day you can hit it. But we don't need to hold on for days and days and days, unless you want to be a swing trader. But we don't need to do that for day trading. All we need is a little slice of the move, right? So free risk to reward ratio is more than enough. Now, let's just remove the Fibonacci. Let's say you wanted to enter on the order block, right? So let's just mark out the order block. This right here is your order block, right? What you would do, you'd enter like this, right? Stop loss at the low. Now, I always say this, I don't keep saying this because two reasons why I guess more people keep joining the channel, which is good. So I'll keep saying this until people understand this. Because this is a liquidity sweep, because price, let me make this very clear. Because price has come out and taken out these stop loss orders, right? This is a fake move. This is a fake move designed only to take out stop loss orders. Very, very unlikely price going to come down, take out this move here, which was just a fake move designed to take out stop loss orders. Very, very unlikely that price is going to do that and then quickly continue on with a direction. Right, if price does come down here, it's probably because we're wrong, right, with the direction, and there's going to be a retracement on the like higher time frames or something. But it doesn't matter, right? Entry pattern doesn't matter. So let's just play price action. Let's just assume you want to enter on the order block, and then you're going to target, let's say free risk to reward ratio, right, like this, and then we're just going to enter the trade, right? Enter the trade, get tagged in, and then let price do its thing. Let price do its thing. Lots of people are just like, oh, they start taking partials, they start moving the stop to break even. Just let price do its thing, right? I literally close the chart. I set my take profit and leave, right? There we go, we hit it. So this is a late London trade, and then you hold on into like early New York, and then you hit take profit. Right, key thing is, once you've got all this analysis, literally, and you're in the trade, just close the charts and move on with your life. No one gets paid to watch their P&L here, right? Because lots of new traders, especially, and this was me, see how price is like kind of chopping up and down. You might be up like 1k, and then price, you know, goes back down to like $500. Like, you don't want to be doing that. You don't want to be doing that because it's kind of hard, especially here, right? Lots of people would panic. Let me see it. See here how we just about missed take profit. They go, oh no, what if it reverses like that, right? Like that. Like, you don't want to be that. I just settle my limit orders and I move on with my life. Like, there's very rarely, maybe like 1 in 20 trades, where price will come all the way up here and then reverse down like that, right? And then someone will go, oh, you could have put your stop to break even. Like, okay, fine, whatever, but really does not matter. Once you do this model and once you backtest it, you'll have so much confidence in yourself and in the model. You won't need to like babysit and stuff. But just sitting through this for like 2 hours, 3 hours, I don't know how long this is, maybe like 2 hours, right? Like 2 hours. There's no point in it. There's no point in it whatsoever. I've learned from trading, right? Set up your limit orders, get tagged in. As soon as you're tagged in, right, you've got your stop loss in there, you got your take profit in there. Let it do its thing. Let it do its thing. And then there are people, you know, some people will be hating on you like, oh, well, that shows you not got confidence. No, it shows you that you're smart, right? Go to the gym, go read a book, go do anything else apart from, you know, looking at the trade, because you're just going to panic, right? I used to panic, and, oh, I'm going to give up P&L and stuff. But yeah, that's just a little bit of, I don't know, I guess big brother advice for like managing your trades and stuff. And for those who are asking, I don't move my stock. I don't take partials or like, you know, a 1 risk to reward ratio or something. I don't take partials at all. I just let it hit my take profit. Now, once I'm up, this is something, I mean, I guess if you really, guys really do care, Once I'm up about 2 risk to reward ratio or 2%, I'll move my stop to break even. But this is really important. This is because I'm swing trading now, because I'm too busy to day trade. So this is on the 4-hour chart. So everything's very slow. If you're a day trader, just let it do its thing. Honestly, let it do its thing. If you really want to move your stop to break even at, like, let's say when you're up 2%, see here, just set it like an order on like, an alert on like MT4 or whatever you trade, right? Just set up an alert, and then once it hits this level, you'll get like a notification on your phone, and then quickly move your stop to break even, right? That's what I would say. Right? Close the charts and then set up, I guess like an alert or wherever you put your price to break even. But literally, that's all you guys need to be a profitable trader. As long as this is so important, as long as you guys have got higher time frame liquidity, right, on a daily or 4-hour chart, and then you combine it with a lower time frame liquidity sweep that we have here, right? Like we have here. So here's our liquidity sweep, lower time frame liquidity sweep. Price moves up in the higher time frame direction, showing us that we are bullish. Then you enter any sort of retracement, ride price up. That is the highest probability trading model. It makes so much money. It's so easy. It works on all time frames, by the way. This will work on the 1-minute chart, and it works all the way on the 4-hour chart.
Okay, so here we are on the 1-minute chart. Now, once you've got your overall direction for liquidity, so if we just zoom out, once you've got your overall direction of where the higher time frame liquidity is, you can look on any entry time frame or any time frame and just ride price up to this key level here. So I'm going to show you it on the 1-minute chart, but this exact setup works on any time frame, right? I use this on the 4-hour chart when I'm swing trading. So if we just look at this price action here, and remember, we're bullish overall, right? We're bullish overall. There is some intraday liquidity here, right? Now, what do I actually mean by that? Can you see how we have highs here, and we also have highs here, right? We've got almost like relative equal highs, and there are lots of people who think that price is going to come down, it's come all the way up, it's going to bounce off these levels and drop, right? So this is our liquidity pool intraday, right? This makes a really good target if you're day trading and scalping, right? Because people ask me this all the time, like, hey Teef, if I get into a position, do I have to target all the way up at this major liquidity pool? No, you just need a 2 or 3 risk to reward ratio in that direction, right? So how do we actually make money from this, right? It's all well and good having the direction, right, and knowing that price wants to come and take out this high. How do we actually make money from this? So what we need to wait for a liquidity sweep, right? And if you remember what we talked about on the daily chart, a liquidity sweep is just a stop run, right? It's just a stop run before price moves off in the opposite direction. So can we see that anywhere in price actually? Can we see a wick that comes down and takes off, let's say it takes some stop loss orders and then quickly moves off in the opposite direction? Can we see any of that, right? So if we just look, right? You see this wick here. You see how this wick comes all the way down, takes out stop loss orders here, and at these equal lows here. And we also go into a fair value gap. And then what do? We quickly and aggressively reverse in the opposite direction. We reverse in the opposite direction, and then we just want to look for any retracement and ride price up, right? Now you might be wondering, oh, Teef, there's no market structure shift, right? Don't we need to wait for price to come all the way up here, close above these highs, and then enter a retracement? I would always say no. I think market structure is a distraction, right? I have so many students who are so close to profitability, but it's market structure that holds them back. And if you remember, we said we've got the overall direction all the way up here, right? We're only looking for longs. We're already super bullish. Like, I'm not on the 1-minute chart saying, oh, I want to see the best price action. I don't care. I'm just looking for any reason to go long, right? All the analysis was done on the daily chart, right? Or you could do it on the 4-hour chart. The hard part was determining where price wants to go, right? All we need now is a simple entry pattern. So people are obsessed with the entry pattern when it's the least important thing, right? And this is where so many people go wrong with liquidity. They think it's the entry pattern. Oh, see, if I want the best, entry pattern, I want a liquidity sweep, I want market structure shift, I want everything. You don't need it. You don't need it. We've got the direction. We know that the higher time frame liquidity is right here. Price, wants to move quickly and aggressively. We're not going to wait for some sort of liquidity sweep and then a huge market structure shift and then, for price to come all the way down to a tiny little fair value gap and give you a 10 risk to reward ratio, right? We're not waiting for that. We're just looking for any reason to get long. So, bit of a rant there, but it's very important that we understand that. Now, I know a few people are going to be like, oh, hey, T, was this not a liquidity sweep here, right? Did we not just sweep out these lows here? Well, let's study this bit of price action, right? Price comes out, it takes out these lows, but it does not take out these lows, right? So we've almost got triple lows, like these, here, here, and here, right? So you've almost got equal lows here. Let's just remove this, right? There are stop loss orders at here, here, and this gets very close, but does not take out these lows here. So for me, that's just, I don't want to say the term inducement, right? Because people are going to get confused by that. This is just generating liquidity, right? It does not take out these stop loss orders here. Now, if you really wanted to, you could have. So you could have put your stop loss here, right? But it's very risky, right? You really want to put your stop loss where there's equal lows right next to it. For me, I would never do that. And if you look, there's a fair value gap right here too, right? So very, very risky. And this is something for you to know. So if you've got equal lows, like we have here, if you've got equal lows like this, and almost another equal low, and you've got a fair value gap, you'll see this all the time in price action. Price will, even, doesn't matter what the direction is, it will just take out this little bit of liquidity and it will go into the fair value gap and it will go in the opposite direction, right? You might think I'm like full of BS, bro. Look at this, man. What? I didn't even know. Like, I just did this just based on, I guess, like my knowledge of trading. But look at that, man. It goes right to, fills in the fair value gap. Beautiful. Shoots off in the opposite direction. So for those who are wondering, hey, is this not a liquidity sweep? Very risky putting your stop loss near these double equal lows, and there's a fair value gap. So, you know, if you did it in this case, you would have lost. But very, 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 very risky. And this is why this is not for beginners. This is not for beginners. This is very advanced trading, right? This is what I use to make money consistently. So don't worry if this is like going over your head, because it's going to take a lot of practice before you actually understand this. But yeah, I'm giving you everything that I use, right? Everything I use in price action to make money. So let's just remove this. Let's just remove this. What's our entry pattern then? So we've had our liquidity sweep. Let's mark it out. We've got our stop run, or liquidity sweep, whatever you want to call it, right? This is our stop run. So let's just liquidity sweep and stop run, right? How do we actually enter? So let's just put liquidity sweep. How do we actually enter? We've got our liquidity sweep here. Price shoots off. Where do we want to enter? Now, for me, I always say this to my students, right? If you've got a liquidity sweep, so if you've got price that wicks out some old low and reverses in the opposite direction, wait for a fair value gap to form, right? Just wait for a fair value gap to form in the opposite direction of the liquidity sweep, right? That's just a hard and fast rule. If you just wait for a fair value gap to form in the opposite direction of the liquidity sweep, that will tell you that that was just a fake move designed to take out stop loss orders, right? Now, not 100% of the time. You're never going to have a 100% win rate, but more often than not, especially this is at a key time of day, and we've got the higher time frame narrative that liquidity is right up here, and we've got double highs right here with more liquidity. Key time of day, we're on the 1 minute chart. It's gold. It's a major asset. You know, price is going to quickly shoot off. We just want to get into the move. So right here is a fair value gap. So let's mark out this fair value gap. Now, you can enter on the fair value gap itself, or the order block, or an optimal trade entry. Doesn't really matter. I just like to wait for a fair value gap, just because it tells me, essentially, that smart money quickly wants to shoot price away. Right? I don't know if anyone's actually explained what a fair value gap is. A fair value gap tells you that price is quickly moving away, right? That's like it's almost a visual way of seeing, you know, price quickly reversing. Just look at this price action, right? This is choppiness, and there's no fair value gaps. Here, price quickly drops, leaves lots of fair value gaps. Price quickly drops, leaves lots of fair value gaps. Price quickly reverses, leaves fair value gaps. Price quickly reverses, leaves lots of fair value gaps, right? So fair value gap tells you, it's almost like a clue that price is going to quickly move, right? So that's why we're keen to just get into any sort of entry. And people might be asking, oh, you know, are these wicks not respecting these order blocks? Like, look, this is the 1 minute chart, right? I don't care about any bearish order block. I don't care about any bearish fair value gap. I've got my direction all the way up here, right? So important. People get on the 5 minute chart and like, oh, you know, this 5 minute, you know, bearish order block got respected. I think there's going to be a shift on the daily chart now, right? Doesn't work like that. Does not work like that. This is all just trickery, right? You got to come onto the lens when you get onto the chart. You got to go, you know, look through the lens. This is all just an illusion, right? This is all an illusion, right? They're just smart money are just thinking, how can we actually get price to this level? How can we get price to this level all the way up here and fuck as many people as possible? That's the reality of it, right? How many stop loss orders can we take? How many people can we get out of their positions so we can take their side of the market and ride price up? That's what smart money is thinking. Like, how many people can we just, like, you know, mess with just to get into our positions and then ride price up, right? So you need to operate under that narrative. Don't look for shorts, only look for longs. And for your entry, you can enter on the fair value gap. So what that would look like, you should enter like this. Right, now people are going to ask me, where do you put your stop loss orders? I'm going to keep on saying this. You have to put it at the liquidity sweep low, right? You have to put it there. There's no point waiting for a liquidity sweep, right? There's absolutely no point waiting for a liquidity sweep if you're just going to put your stop loss like here, at this, fair value gap low or this order block, because price can easily wick down here and then go up and take you out, right? You do not want that. You have to wait for a liquidity sweep. The whole point of waiting for a stop run or a liquidity sweep was so you can put your stop loss orders in a safe place, right? In a safe place where it's very unlikely that price will, hit it and tag you out, because so many traders get this right. They think they understand liquidity, right? They think they understand liquidity, but this happens to them, right? The bullish price comes out, takes out their stop loss, and then comes up, gives everyone else another retracement, and hits take profit, right? Hits the major liquidity pool. And that used to happen to me for years, all because I didn't wait for a liquidity sweep and I didn't put my stop loss at the liquidity sweep low. So for your take profit, you can target 2-to-1 or a 3-to-1, right? And that price just do its thing. You do not need a massive risk to reward ratio. And let me tell you, I know so many profitable traders, they all have between a 1 or 3 risk to reward ratio, right? They don't have a 10 risk to reward ratio. And these guys on Instagram are just, they're lying to you, right? You don't need a tiny stop loss. You just need consistency, right? You don't need perfection, because the reality is there is no perfection in these markets. So let's just play price action and let it do its thing, right? So you would have easily got your 2 risk to reward ratio, for those who are wondering. 3 risk to reward ratio, this is what I aim for. I will aim for a 3 risk to reward ratio in the overall direction, right? The overall bullish direction. If you really wanted to, you can aim for this. If you really wanted to, right? If you're one of those traders, you can, but just be prepared that price can do this very easily. It can do this. And then start to reverse, consolidate, through Asia, and then have a liquidity sweep, let's say, in London, come close to it, and then New York. And then in New York, you might hit it, right? So you might have to hold like a day, which is not good, right? It's not good if you want to be a scalper, but let's let price do its thing. Let it do its thing. Don't worry about any retracements. Trust the logic and let price do its thing, right? Let it do its thing. Let it do its thing. And like that, right? Nice, peaceful trade. Price hits your take profit and easy trades. Easy trades. Now, at first, this might seem like super complicated, because it can be complicated. It can be complicated, but you need to operate under the lens that, first of all, you get on the higher time frames. You don't even look at the 1 minute chart or the 5 minute or even the 4 hour chart. You get on the higher time frames. You look for the overall direction. You look for the liquidity. You ask yourself, where is the money? Where is smart money moving this market to? Right? Where's the major high or low with stop loss orders that smart money are moving the market to? Right? That is your number one goal as a trader. You got to have a fee. You got to have a direction where you think the price is likely to go. Right? If you don't have a direction and you're looking for an entry pattern, you're just gambling. But that's just gambling. You have no idea what's going to happen. There are fair value gaps here. There are bearish fair value gaps. There are bullish fair value gaps. If you're just buying and selling randomly these fair value gaps, you're not going to make any money. And I see these people asking me, hey, Steve, is it all right if I use this trading view fair value gap indicator? It's like, it's going to mark every single fair value gap out. And it's pointless. You don't need any of these fair value gaps. You need the logic first, and then everything falls into place. Right? Super important. So once you've got your bias, right? Once you've got your overall liquidity direction, then and only then do you want to get onto your entry time frame. Right? So if we've got the direction and the bias on the daily and 4 hour chart, we're not going to get onto the 1 hour chart, 15-minute chart, and 5-minute chart if you're a 1 minute trader. Right? We don't care about that. We only care about our entry time frame and the higher time frames. And that's something that I got confused with quite a lot, right? Because the 4 hour chart, daily chart, weekly chart would be bullish, but then the 1 hour chart would be bearish, and I'd be like, what's going on? Do not go below the 4 hour chart to determine your higher time frame liquidity. Right? Super important. Do not look at the 1 hour chart. Do not go below the 4 hour chart. You need the daily, weekly, or 4 hour chart, right? Super important. But once you've got that, you get on your entry time frame and you look for a liquidity sweep, right? You're looking for a stop run in the opposite direction, right? Any sort of, you want to see some sort of large wick, ideally, take out some stop loss orders, quickly move off in the opposite direction, leave a fair value gap for you to enter on that fair value gap, ride price up for a 2 or 3, risk to reward ratio in the overall direction. Now, if you're lucky, let's say this is 1 day, right? You hit your take profit of a 3 risk to reward ratio. Price can consolidate, and then it can give you the same entry, the liquidity sweep here, comes up, another fair value gap, and takes it out, right? And of course, if price is all the way down here, let's say, you will get many days, even a few weeks of the exact same setup occurring every single day. And if you trade, let's say, London and New York, you can get maybe 10 trades if price is all the way down here, riding price up to these highs, right? And that is how you day trade and scalp profitably, and that's how you swing trade too, right? This is the exact same setup. We just remove this. It's the exact same setup that I use on the 4-hour chart, right? So forget the time frame, focus on the logic, right? Higher time frame liquidity gives you your direction. Liquidity sweep gives you the high probability entry, right? Liquidity is the direction. Liquidity sweep is your edge, right? Super important. Like, you need both, because if you don't have them, you're not going to make money. And to be honest, there's a third one that no one talks about, which is psychology. Because if you don't have the psychology right, you're like it's almost like having a gun with no ammo. Doesn't matter. You can have the best weapon in the world. If you've got no ammunition, you're not gonna do any damage with it. So you need to have the right mindset. You can't be, in a point where you have, 1 loss, 2 losses in a row, 3 losses in a row, and you start freaking out, right? I mean, I don't know if you follow me on X or no. This week, right, I had 5 trades. I had 2 winners and 3 losses, right? So I had a 40% win rate for this week, but I still ended the week 3% up, right? Because I aimed for a free risk reward ratio. If I was in the point where I had 3 losers, because at first I had 3 losses, right, back to back to back. If I was at the point where I'm like, oh, I can't do it, liquidity sweeps don't work, I'd be in a never-ending cycle, and I was in that cycle for 4 years. So if you want to fix your psychology and you want to make money, make sure you go watch this full, completely free 2-hour trading course where I break down everything in as much detail as possible. Daily bias, liquidity sweeps, and probably most importantly of all, how to finally fix your psychology once and for all. No meditation, no stoicism, just real stuff that actually works. So I'll see you in that video on screen now.